The RBA pauses interest rates for the first time in 10 months. This is a very interesting decision that's just come out from the Reserve Bank of Australia. For the first time in 10 months, the interest rate is not increasing. For many people, they would probably see this as a bit of a sigh of relief. But let's have a little bit of a look as to some of the reasons the RBA has got to this particular decision. So this is the official statement from Phil Lowe, the Reserve Bank Governor. And as you can see, at the meeting today, the RBA decided to leave the cash rate unchanged at 3.6%. For the first time in 10 months, we're not seeing an interest rate increase. This decision follows a cumulative increase in interest rates of 3.5 percentage points since May last year. So this is one of the sharpest increases that we've seen in this particular time period, particularly here in Australia. They go on to say that the board recognizes that monetary policy operates with a lag and that the full effect of this substantial increase in interest rates is yet to be felt. So what they mean by this is a couple of things. Firstly, they are well aware that there are thousands, hundreds of thousands of people out there with fixed rate loans that do not roll off until later in this year and potentially even further than that. So for that group of people, they wouldn't be feeling these interest rate hikes one bit, at least not yet anyway. Additionally, the board took the decision to hold interest rates steady this month to provide additional time to assess the impact of the increase in interest rates to date and the economic outlook. They're acknowledging that global inflation remains quite high. They also go on to say here that the banking system problems in the United States and Switzerland have resulted in a lot of volatility in financial markets, which we've all seen in the last few weeks. This is very, very interesting. A bit of a reassuring statement by the board here saying that the banking system in Australia is very strong, well capitalized and highly liquid, and it's well placed to continue providing credit that the economy needs. Very interesting, reassuring statement there from the RBA. This is suggesting that inflation has peaked in Australia. Goods price inflation is expected to moderate over the months ahead due to global developments and softer demand in Australia. So that's kind of indicating that whilst the full impact of the recent rate hikes hasn't yet been felt by the entire economy, it is somewhat felt in that there's a softer demand in Australia for people wanting to go out there and spend their money. And that's obviously adding to inflation softening in that time period. They do go on to say here that meanwhile, rents are increasing at the fastest rate that we've seen in some years, with vacancy rates so low in many parts of the countries. That's an interesting one for investors. If you have investment properties, regardless of where it is, but particularly on the eastern seaboard, you would know full well that the rents, once they have come up for renewal, have gone up significantly. Like I've got multiple properties in Queensland. The rents on these properties have gone up anywhere between $50 and $100 in the last 12 months, which is insane. So let's take a look now at the cash rate futures. And this was the cash rate futures implied yield curve as of yesterday. So close of business on Monday. RBA made the decision on Tuesday. The markets yesterday were pricing in exactly what's happened today, and that's an interest rate pause, and that's what you can see right here. They are, according to the markets here, anticipating a potential rise in May and June. At this particular point in time, I would say that things would remain pretty flat until we get to sort of August and September. They're pricing in interest rate declines, and you would have seen some of the interest rates, fixed rate terms with some of the big four banks. They are also predicting an interest rate decline over the next sort of 12 to 18 months, which is going to be very interesting. So what does this mean for everyday people like you and I? Obviously, for those of us that have debt at this point in time, it's going to be a bit of a sigh of relief not receiving a letter from the bank next month saying, hey, your interest rate is going to be increasing. On the flip side though, inflation is definitely hurting some of us. So if you've got savings that's parked with the bank right now, the interest rate that you're receiving on that savings versus where inflation is at right now, you are losing the difference. So technically you're losing money. If you have debt, on the other hand, it's a bit of a different story because the interest that you're paying on your debt versus what the inflation figures currently show is a bit of a different story. And I've always maintained that you pay off today's debt with tomorrow's inflated dollars. That's all from me today, guys. Quick update on the RBA's decision. Stay tuned over the next couple of months. This is going to be a very interesting ride. Thanks for watching. I'll catch you soon.